Welcome to Kitco News. I'm Niels Christensen. So one investment firm is saying that gold is now embarking on a decade-long bull run, with prices driven by higher inflation and a new monetary policy regime. Here to talk about his 14th annual In Gold Trust report is Ronald-Peter Stoeferle, fund manager at Incrementum AG. Thank you very much, Ronald, for joining us today.
Thank you very much. Hope you're well. All good and safe.
I am. Before we get started, I just want to say no soccer references in this email. I'm North American. I don't know anything about soccer.
We can go with I don't know, with baseball, with hockey, with lacrosse, whatever you want.
Excellent. 14th annual In Gold Trust report is out now. You're saying gold prices are embarking. This is going to be the dawn of a golden age for the market. Let's just jump right into this. What are your thoughts? What does gold look like in the next 10 years?
Well, from our point of view, we're clearly in a new bull market, and markets are always strongest when they're broad, and then they're weakest when they're narrow. At the moment, Niels, we're seeing that gold is rising in every currency. So basically, gold did make new all-time highs in every currency, but the US dollar. And from our only a question of when we will reach all-time highs in US dollar terms as well. But then gold is also rising against bonds, and gold is also rising against stocks. So we can see this is basically a bull market where you can say, okay, let's go to the beach for a couple of weeks. This is going to be fine. This is just a very, very solid bull market. We're also seeing that mining stocks do confirm this bull market. We're seeing a very high volume in the mining space. So I'm pretty confident that we're like at the beginning of this second stage of the trend, which is the so-called public participation phase. And this is the phase which is the longest and which is actually the most fun part of a bull market. And as you know, the last couple of years were pretty tough in the gold and in the mining space. And as Bob Farrell once said, bull markets are more fun than bear markets. So yeah, I think we'll have some fun in this bull market.
So what's going to be driving prices? I mean, in the report you talk about a new monetary policy regime. You said normalization has failed. It took 2 months to undo 10 years of trying to normalize the market for the Fed. So what's your expectation for monetary policy, and how does this impact inflation going forward?
Well, we wrote a book called The Zero Interest Rate Trap, and when we published the book, the US still actually had rates at 250. Now we saw that they were already lowering rates starting last year. They were already increasing their balance sheet last year. We can see that all the quantitative tightening that was done, was basically it was a bad joke. Now, so from our point of view, it is really important to say, and this is one of the main parts of the report, that the Corona crisis is only the straw that broke the camel's back. There were already lots of signs that the economy is getting weaker. Global trade was falling by 0.5% in 2019. We only saw that in 1980 and in 2009 at the beginning of big recessions. So it was pretty obvious that the economy is weak. Now, what we saw in the last couple of weeks, and we only have those numbers until end of April, we saw massive monetary and fiscal stimulus. Just to give you one number, it is 21 trillion that were injected into the system from central banks and also in terms of fiscal policy. This is 23% of world GDP. You could buy all the gold that was ever mined in the last couple of 100,000 years. You could buy that twice with that amount that was created in just a couple of weeks. You could buy all the annual gold production 120 times. So those numbers are just staggering, and this is just the beginning. From our point of view, the debt situation that we're seeing in industrialized nations now resembles quite, I would say, the debt levels of banana republics. So what does it mean for gold? It is basically impossible that we will see significantly higher real interest rates. And from our point of view, one of the most important drivers for the price of gold are opportunity costs. So if we see real rates at 3, 4, 5%, then of course many investors, many prudent investors will say, okay, opportunity costs for holding gold are too high, but we simply cannot afford higher real rates. Now, how do usually such debt levels get kind of resolved? Of course, financial repression, capital controls. I think we cannot grow out of this mess. And if you study history, inflation was, of course, always the main solution. And this is exactly what we're seeing coming up in the next couple of years.
So, do you think, and in your report, you actually called gold sort of the stateless reserve currency now. What do you mean by that? And I just sort of wonder how, is the gold market big enough to be a global reserve currency? I mean, is that why we need to see much higher prices going forward to sort of meet that new status?
Well, it's only a matter of price. I mean, from our point of view, what we can really imagine is that, first of all, we will reach the limits of debt sustainability. But what we're also seeing at the moment is the end of central bank independence, which will be a very, very important driver. Now, down the road in the next decade, we might see, if we say diplomatically, some sort of a reorganization of the international monetary system. Now, Niels, I think it's no coincidence that the US still holds more than 8,000 tons of gold. The Eurozone holds more than 10,000 tons of gold. The Chinese officially own more than 2,000 tons, probably much more. The IMF holds 3,000 tons. The Russians have got more than 2,000 tons. So I think the most important players already have very high gold reserves, much higher gold reserves or higher gold allocations than most investors, actually. So I think if there is some sort of a reallocation of this monetary regime in the next decade, I think that gold will play a major role. And in our report, for the first time, we did some really long-term valuation analysis based on our proprietary valuation model. And the numbers that we come up with, for many people, they're quite staggering. But from our point of view, this is very, very much likely to be achieved at the end of this decade.
A lot of people have said, actually, that we don't really want to see $10,000 gold. I mean, what's the economy have to look like, the global economy have to look like for a safe haven asset like gold to go that high? I mean, is this I don't want to say doomsday scenario, but I mean, a lot of people are, have said that, the economy for gold prices to sort of reach that level, the global economy is going to be in serious crisis.
Well, just a thought experiment. You're on 15th of August 1971. If you would have said, well, the price of gold in 2020 will be at 1,700 and not at 35, you would say, okay, this is impossible. This will be a world of civil wars, of hyperinflation, whatever. From our point of view, gold is a very reliable hedge for monetary inflation. So actually, if we come up with our, and that's really the conservative price target for the year 2030, which is $4,800. This is a compound annual growth rate of 10.9%. So if we have 10.9% annual growth in the price of gold, we will end up at 4,800 in 2030. Now, the interesting thing is, since 1971, the annual growth rate of the price of gold is roughly 10%. We know that the supply of gold, so the natural gold inflation, is roughly 1.6%. And on the other hand, if you compare it to the growth of monetary aggregates, this is between, I know we use different probabilities and different scenarios. But for example, in an inflationary scenario like the 1970s, M2 growth was 10%. So from our point of view, gold just preserves your purchasing power. It stabilizes your purchasing power. And then, of course, in 2030, if the price of gold should be at 5,000, whatever, we probably will also see that a pint of beer will be, I don't know what it is in Montreal at the moment, but over here prices are ridiculous. Who would ever have thought that we will pay, I don't know, $5 for a beer? Who would have expected that like 20 years ago? But as you know, we try to calculate and compare the purchasing power with different other asset classes. So we compare the price of gold to bonds, we compare it to stocks, but also of goods of real life. And it just tells you that over the long term, and this is why we come up with this decade view, over the long term, gold is the most reliable hedge for your purchasing power that you can have.
Okay, so let's move from gold. I mean, obviously you're bullish on gold. What does this mean for the mining sector? I mean, we've already seen first quarter numbers. They've been enjoying higher prices, lower costs. Is the miners a better way to play the leverage on gold?
Well, first of all, I think one shouldn't mix up physical gold, which is a security, or like, let's say, an insurance or an insurance for uncertain times, and mining stocks. We have seen this tremendous volatility in the mining space in April, and of course they carry different risks compared to physical gold. But from our point of view, they're still quite cheap, because what we've seen in the course of this bear market was that debt has been reduced. The companies really got their balance sheets in order. They are focusing much more on capital discipline. They were growing their margins and their cash flows. We're seeing, and this is a very, very important factor, very cheap energy prices, and we're seeing that local currencies like the Canadian dollar, the Australian dollar, etc., are extremely weak versus the US dollar, which is an additional boost for earnings. We have seen, Niels, quite constructive M&A activities in the last couple of weeks. We know that normally at, in the boom times, we see real value destroying M&A activity. We're far away from that. We will see that at some point, but the last couple of deals from our point of view really made sense. Now, if you have a look at the volume that is traded in the big caps, like Barrick Gold, like Newmont or Franco, you can see those volumes are really significant. So it tells me that generalists are coming into the market. It is not only gold mining funds that are investing now. It is really generalists. It is really pension funds that they're coming into the spot. And from my point of view, earnings visibility will be a very, very important factor. Now, we have seen the Wall Street Journal wrote that a couple of days ago that more companies in the S&P 500 have suspended or canceled their dividends so far this year than in the previous 10 years combined. So there is much lower or almost no dividends that are paid out by other companies in the broad market. On the other hand, in the mining space, many companies significantly increased their dividends. So actually, I mean, that might sound odd for many investors, because the last couple of years were really frustrating. But I see tremendous value in the mining space.
It's interesting. I mean, who thought, back in 2015, would we be thinking of using the mining sector as a reach for yield? It's it's a little mind-boggling.
It is. I mean, it sometimes feels like in the children's book Opposite Land, which is a tremendous book where everything is just upside down, and if you have to pay to lend highly over indebted countries money, if you actually have to pay what we've seen in the oil space recently. I mean, those are developments that are crazy, and at some point I think that economic theory will come into play again, and that we just cannot the fundamental laws of economics over the long term cannot be ignored.
I wanted to end with this, so your report is 300 plus pages. Year of research goes into this. What is sort of the one element that really jumped out at you when you were writing this report? What was the surprise for you when you were doing your research? Besides the price of gold compared to beer.
Well, actually, we also got a comparison of gold or the purchasing power of gold measured in football players, in soccer players, because well, that's one for you, Niels. But I think what's really important to understand is, if we compare the 2008-2009 crisis to the current situation, last time we saw that central bank policy basically tried to solve the problems. This time, first of all, central bank policy was much more aggressive. They acted much faster. I mean, who would have thought that the Federal Reserve would intervene in the corporate bond market and would basically bail out the whole sector? But it was not only central bank policy that was extremely aggressive, it was also fiscal policy. Now, what we're seeing, and this is something that will probably be more important going forward, is the fact that we're seeing a much tighter, central bank policy and fiscal policy are much more intertwined. If you have a look, for example, at the Bank of England, they basically directly finance now the UK government. We have seen comments coming out from New Zealand that were really mind-boggling. You wouldn't expect such comments from a central banker. And I think that last year, when we wrote about MMT and helicopter money, this was something where people said, okay, yeah, that's just, weird economic theories from guys sitting in their ivory tower. But now I think it is probably only a question of when those measures will be implemented.
Yeah, I mean, helicopter money actually is kind of a reality in Canada. The Canadian government is providing $2,000 a month for anybody who has been affected by the coronavirus pandemic. I mean, literally you get $2,000 because you're staying at home. So I mean, like, it's not theory anymore. Now we just need to figure out the impact.
Exactly. Yeah. I mean, the thing is, of course, I mean, I think that those measures are they don't increase inequality as much as quantitative easing, for example, does. Because if you have a look at asset price inflation since 2008, I think it is no wonder that populists are coming up all over the world, because this gap between rich and poor is just getting bigger and bigger. Now, on the other hand, this is pretty similar to free beer. People get used to those measures, to government handing out everything for free, to universal basic income quantitative easing for the people, whatever you want to call it. We tend to forget how big those sizes nowadays are. I said 21 trillion just injected into the system until April. Now, if I say gold might be at 5,000 whatever in 2030, I think many people say, okay, that's just way too high. But who would have expected such dramatic actions from central bankers and fiscal policy over the last couple of years? So from my point of view, it is a pretty safe and conservative call. And we should not forget, gold is not mainstream yet. We should not forget that institutional players basically don't have any allocation in the mining space, in the physical gold space. And once the biggest bubble pops, and the biggest bubble is, of course, a bubble of confidence in government bonds, then we will see a real shift into the gold market. And from my point of view, those 15 trillion US dollars that are invested in negative yielding bonds at the moment, if inflation will pick up, and at some point it will probably in a couple of quarters, then this liquidity will have to go into markets or sectors that are traditional inflation hedges. And gold actually did this job pretty well over the last couple of centuries.
Thank you very much, Ronnie, for your thoughts today. Your report, once again, is an eye-opener for the gold market.
Thank you, Niels. And the next time I'm going to come up with some, I don't know, lacrosse or hockey analogies just for you.
Excellent.